Please come to the next chapter, risk management. This is a theory topic, and if you are very interested in risk management, then there is an entire elective paper called risk management. So this is just a small gist of, a glimpse of what is there in the risk management. Business entities face lot of risk, and you can't stop doing business just because there is risk. So we need to understand the risk. What are the causes of the risk and how the risk can be mitigated, reduced or eliminated. So in this chapter, we'll have a very brief understanding of different types of risk which a business faces, few examples from our practical life, and then how can we mitigate the risk. So small chapter, and let us pay attention. For a theory question, they can ask you what are the various types of risk faced by an organization. So you can see in the on the diagram, entity faces various types of risk, like where should we start from? Interest rate risk, political risk, country risk, financial risk, operational risk, compliance risk, and strategic risk. Of course, this list is not enough. This is just an idea of some of the major risk which a business entity will face. So if you want to do business, be ready to accept such risk. So even if you start your practice after you qualify, you will have to face this risk. Okay, not all, but some of the risk. Like for example, you may have a compliance risk. If you do not comply with the law, if you give a wrong advice to the client, if your staff does a wrong data entry, instead of paying a GST of 100 rupees, he makes your client pay 10 lakh rupees. He puts some extra zeros. That is the operational risk. So we have to face this risk if we want to do business. So this topic tells you that we should know what are the risks we have. We must be aware about the risk, causes of the risk, and try to mitigate those risks. So let us start with the first risk that we will call strategic risk. Strategy means your future plan of action to achieve some desired goal or objective. Every business entity will prepare some strategy so as to generate profit, so as to increase their sales, increase their market share, make their product more appealing to the customers, etc. Cost cutting. But is it possible that every strategy that you make may turn out to be true, may turn out to be as you had wished it to be? The answer is no, because so many external changes can take place and which will make your strategy go completely wrong, and your strategy can become a big failure. All your resources that you might have devoted for that strategy will be a waste of time and energy, but that is possible. Even the well thought out plans can go wrong. So suppose a company like Tata Motors starts to launch a nano car, a strategy which thought that the whole country, every middle class, poor person, student, office goers, everybody will jump to this car of 1 lakh rupees or 2 lakh rupees, such a low priced car, but it did not become successful. Okay, so that is called strategic risk, where your strategy can fail. A risk in which, so how do you present the answer? If the question is what is a strategic risk, so this risk in which a company's strategy becomes less effective and it struggles to achieve its goal. A successful business always needs a comprehensive and detailed business plan. That's very true. Without a comprehensive business plan, your organization will not move forward. However, if things changes, like for example the government policy has changed, you have made a very good car which is driverless car, but then the government of that country bans such cars because they think there can be more accidents. So your strategy has failed. Okay, customers' taste and fashion can change suddenly, and therefore your strategy may not work at that time. So even the best laid plans can become outdated if cannot keep pace with the latest trends, and that is what is called strategic risk. So one has to really look at the environment on different aspects and see how that change in that environment can affect your business. So some of the reasons for strategic risk, we have to understand what are the different types of risk and what causes such risk. So what causes the strategic risk? Technological risk. The technology may change, and in every sector nowadays the technology is changing very rapidly. So whatever plan you will design may turn out to be wrong. So like for example in education sector, online education has become popular. So those who have opened big universities, big classrooms with lot of hostel facilities, so they are finding it difficult to run those institutes now, because people will prefer to study at home on mobile phone, laptop, online. Next reason is a new competitor entering the market. So some of the mobile phone companies in India were doing very good. Then suddenly Jio came and it offered free services for years together, months together, and all of a sudden all your strategy went for a haywire. Third point, shift in the customer's demand. Customers demand fashion, taste, hobbies, habits, they will keep changing, and you have to understand what do they want right now, and accordingly your product has to be designed. Otherwise your strategy can fail, company can fail. Increase in the cost of raw material. You are a pharmaceutical company, you are importing from China raw material, but because of the Indian government putting ban, the raw material cost has gone up. So now you are sourcing from other countries, cost has gone up, and therefore now your product is unviable. It can't compete now in the international market. Or any such large scale changes. Suppose a massive pandemic happens, global pandemic happens, and this might really affect all your well planned strategies. So as a businessman I need to be aware about such strategies. Let us look at three examples of companies. Some companies were able to understand the need of the changing requirement, changing environment, and they changed their strategy quickly. Some companies could not do it. So those who could change with the time, with the requirement of the environment, they were able to survive. And other big companies, giant companies, now they are struggling to survive. So one of the companies which was a global leader in photography, Kodak, and there used to be a punchline, the Kodak moment, smile, Kodak moment. Where is that company now? This company is finding difficult to survive. It had developed a digital camera. It had developed a digital camera way back in 1975. You may not be aware, earlier the cameras used to have some kind of reel. You put the reel, then you click the reel, you have to go to some shop where they will convert into a photograph, that is print out. And digital camera means you just click the photo and it is in digital form, you can immediately transfer it to your laptop, mobile, etc. So what will people prefer, a digital photo or that print out? Digital photo can be easily shared, you can take many photos without much cost. Even a small child can use digital camera easily. So they had developed it, but they did not introduce in the market because they thought that their existing product will not sell that in that case. So your own product will kill your other products in the market. But it considers this innovation as a threat to its core business and failed to develop it. So therefore, it did not take too much efforts to further develop the digital camera unit because it thought that it will affect its existing core business. And then what happened? It has to pay the price. Why? Because other companies develop digital cameras. The digital cameras developed by other companies become more popular. They have already captured the market share, and by that time Kodak realized it, it was too late and it left behind. So in fact, this Kodak company had filed for bankruptcy also in US. And the world famous example is that of Nokia. From your general knowledge, you might be aware that Nokia was the world leader in mobile phones. At a point of time, they had more than 90% of the market share in mobile phones, more than 90% global market share. Almost everybody on the street will have a Nokia phone. But then what happened? This Nokia phone had a touch screen, keyboard based screen, keyboard. So you have to type 1, 2, 3 here, and then you can send messages, etc. So it was so difficult. Then Apple and Samsung company came out with a touch screen mobile phone which don't have keyboard. You can use the entire mobile phone as a touch screen mobile phone, and with much faster processor, internet in that. So they came out with the smartphones, whereas this was still the old age phone. And you find that the whole world shifted to those smartphones. Nokia could not develop its mobile phone that fast, and now it is just struggling to survive. It has been taken over by Microsoft company. So this is an example of how a giant company like Nokia failed to upgrade itself. It could not upgrade its technology on time, and by the time it could do it, the other competitors were able to capture the market, like Samsung and Apple. Now they have become market leader in the touch screen mobile phones. Nowadays I hardly find any student in my classroom using this Nokia phone, whereas in the first batch that I took, almost everyone had that same Nokia phone, some famous models like 3310, etc. I had also purchased one Nokia phone, first mobile phone. And now you look at another company called Xerox. Photocopy means Xerox. When you go to some shop, instead of saying, sir, do the photocopy of this paper, you say Xerox it. That is so powerful brand. They were able to really upgrade themselves. They came out with better and better technologies, faster technologies and cheaper technologies, and they are still able to survive in the market. So it had invented photocopying machine. When laser printing was developed, Xerox was quick to lap up the opportunity and changes its business model to develop the laser printing. So it survived the strategic risk. If it had not adopted that laser technology based printing, then probably it would have also made the similar fate like Kodak and Nokia. So it is one of the most powerful brands. Still it continues to exist, making huge amount of profit. Now let us see compliance risk. Next point. What is compliance risk? When you are operating in any country, you have to follow the rules and regulations of that country, whichever that country is. And if you are operating in global level, you have imports, etc., then you have to comply with not only the regulation of your own country, but you also have to comply with the international regulations applicable to you. And what if you do not comply with the regulations? Knowingly or unknowingly, if you do not comply with the regulation, there is a cost of that. So you may be first fined, then penalty, interest, imprisonment, closure of business. This is what can happen. Fine. Okay. And this will result into losses for you. You have heard the story of Vodafone and income tax department case. So this Vodafone company has made some compliance error. They have not properly deducted TDS while making payment to the previous owner Hutch, and they are still facing the legal tangle. The matter is still not over. So more than 10,000 crore rupees they are still required to pay to the government for failure to comply with the income tax regulations. So imagine if such a huge penalty you have to pay, company's existence may be doubtful now. So every company needs to comply with rules and regulation. For your information, large companies have nowadays compliance officer. The purpose of putting such person in office, that he will ensure that all regulations are timely and sufficiently complied with. So in India, if you look at businesses, they have to follow GST, then you have to follow income tax, company act. If you are a listed company, then SEBI, profession tax, labor laws. And if you are a factory kind of organization, you have more number of labor laws. Then local laws, whatever are the rules and regulation in the local city, that you have to follow. And you make mistake in any of this, and you are be ready to pay the penalty, fine, compensation, etc. So that is why this is a serious risk. Knowingly or unknowingly, you might make some error and you are on the wrong side of the law, and they ask you to pay penalty. For example, Companies Act 2013, continuous updating of SEBI guideline. Each business organization has to comply with plethora of rules, regulations and guidelines. Plethora means huge number. In fact, if you do business, you'll get tired, you'll get mad while complying with these regulations, and you have to ensure that nothing is missed out. So you have to know what is the TDS. For example, this is the challenge which I face: TDS rate for various types of payment. If you deduct less, they will charge you interest and penalty. You have to know the last date of payment of TDS. Then you have to pay advance tax on time. There are multiple dates, multiple percentage, and same thing for GST. I have never understood so many returns you have to file on different dates, right? And if you are a company form of organization, again you have to comply with long list of Companies Act. Businessmen's half of the energy goes in such compliances, and the difficult part is if he does not comply, then he will have to pay penalties, fine, and even imprisonment also. Failure to comply with laws will pose a serious threat to its survival. As I gave you some example, that a company is asked to pay 10,000 crore rupees plus interest on non-compliance of income tax law. Had it not been Vodafone but a normal company, then it could not have survived. In order to pay all that income tax, fine, interest, penalty, this company would have closed down. So that is the problem. The one more thing you might have heard, in case of telecom business, The Supreme Court had asked many telecom operators like Airtel, Vodafone Idea to pay huge amount of uh, money as penalty because they had not complied with certain past agreement with the government. The amount is so huge, it goes into thousands of crores of rupees, that the survival of Idea was doubtful, that whether they can pay those thousands of crores of rupees or not. So look around you when you are doing business. Check for every compliances. Okay, like you have to register your firm under Shop and License Act. If you have employees, you have to pay that profession tax, GST, income tax, local tax, etc. Now we'll come to the next is operational risk. This is the risk, something which can happen to any company at any time. We really don't know how to completely ensure that this risk does not happen. These risks relate to people and process. So you may have a wrong process. So for example, a company like MasterCard, you will find this in the newspaper or you can do some Google search. They have been deducting more charges when the customer is making payment using the MasterCard. It is like MasterCard, Visa, Rupee, the debit credit card that you use. They were charging more charges for many years. Maybe there was some wrong process or whatever, and the court has asked them to pay billions of dollar as penalty. Billions of dollar as penalty. That's a huge amount. So much penalty you have to uh, give just because something wrong has gone in your process of calculating the charges that you levy on the card users. There can be people risk also. You can't guarantee the honesty and integrity of every person who is working in the organization, and sometimes the people might do some mischief and it can cause loss to the organization. They can simply steal the goods of the company. They can transfer the data to outsiders for some money, and therefore there is a risk. When people will work in the organization, there is going to be this risk, and it is an inherent risk, internal risk and inherent risk that is there. You really can't guarantee how persons would behave. It also relates to failure on the part of the company to cope with the day-to-day operational problems, right? One example first we'll read from the book, and today as a homework you will write two examples that you observe in the organization which can be an operational risk. An employee paying out rupees 1 lakh from the account of the company instead of rupees 10,000. So I asked my employee that we have to make this payment, so please pay 10,000 rupees from our account. So what he did, instead of paying 10,000, he put one more zero. I was also in a hurry. I don't have so much time to check each and every line item, each and every number. I relied on my employee. He is an honest employee. His intention is also honest. But for some error, it was 1 lakh and we ended up paying 1 lakh rupees. Now what do? I have to recover it from the party. Now that party is no longer available. All routes are closed to this mobile number. This mobile number is switched off. So that is a people risk. Okay, or a process risk also, because there should have been some process to ensure that before you make the payment, there is a double check, cross check, and then only the payment can be released. So this is a people and process risk which can happen in any organization. Now I will come to financial risk. You are a champion of financial management subject. Okay, you are god of financial management, uncrowned king of financial management, of course queen also. So when an organization is doing business, it is exposed to several types of financial risk. You can't avoid it altogether. With your alertness, you might reduce it, but you can't completely avoid it. For example, the inflation is high and suddenly the prices of all the inputs go up. That is a kind of financial risk. You will have to shell out more amount to procure the raw material or component. And then same thing, the exchange rate can change. You use imported raw material, imported component in your production, so this cost will go up because of exchange rate. If you are an exporter, reverse can happen. The exchange rate can collapse and you might suffer a heavy loss. Then your credit rating may change. If your credit rating may change, then it may become difficult for you to borrow, right? Or you can borrow only at a heavy rate of interest. Market interest rate may change. Market interest rate can change. For example, you have borrowed at a floating rate. Now see, you have already studied interest rate chapter. Floating rate LIBOR plus 4%. When you borrowed, LIBOR was 2. You were happy that you have to pay 6%, but then over a period of time, LIBOR changed to 7 over a period of time, and then now you will have to pay 11%. Your interest cost will go up. If you have invested in a fixed rate security, like you have purchased fixed rate bond, many companies invest in fixed rate bond. Now if the market interest rate goes up, the value of bond will fall. That is also risk. So there is a risk in fixed rate also, there is a risk in floating rate also. Next risk is unexpected political change in any foreign country, which may lead to country risk and which may ultimately result into financial loss. So change in the political situation in a country can also lead to financial loss. That country may ban the outflow of funds to your country. That country may ban or freeze your account in that country, and that may result into financial loss. And this can happen when the relationship between two countries are not good. Like lot of bad blood is flowing between India and Pakistan, India and China, America and China, and that results into country risk. Next risk we will call counterparty risk. That means the counterparty can default and you will suffer the loss. A sold goods to B worth $1 lakh. B was supposed to pay after 3 months. B defaults. B does not pay. So the failure of the counterparty to perform his obligation to pay will result into loss to this company. That is counterparty risk. So the simple example is a receiver may not be collected, debtor may not pay, or in case of forward contracts, the other party may refuse to perform his set of obligation. So that is counterparty risk. So this risk occurs due to non-honoring of the obligation by the counterparty, which can be due to failure to deliver the goods also. Reverse also can happen, and it has happened with me also recently. I paid an advance for delivery of goods to some company. This is my example. And then that company did not deliver the goods only. Then I called them. They said we will deliver after 2 days. Again I called 2 days, and it is more than 3 months now. They have still not delivered. And now their phones are also switched off. Then I have filed a police complaint. Police is also tracing them. They are not available. So this is the counterparty risk. Fortunately, amount was little small, so I am still there. Okay. Reverse can also happen. Somebody may have taken a loan and has not paid either interest or principal. This risk also covers the credit risk, that is the default by the counterparty. So when you will do the business or when you will start your practice, I will tell you this risk will haunt you more. Most of your client who will ask you to file the return, ask you to attend their hearing, appeal, but when you will ask the payment, then they will show their true color. Counterparty risk. A CA is highly susceptible to counterparty risk. Political risk. India and China. Always there is a tension on border. Sometimes China will claim India has encroached on their territory. Most of the time India will claim China has entered into their territory, this valley, that valley. Okay, and they will have their troops on the border. India will send 50,000 soldiers. They will send 1 lakh. They will put their fighter plane. They will also put. So what Indian government thought, let us teach these Chinese some lessons. So they will ban products, and if you can't ban products, you ban their apps also. Okay, so you'll put a ban on TikTok and whatever, I don't know, that PUBG or similar kind of games, and more than 200 apps will be banned, products will be banned, movement of people can be banned, doing businesses with such countries becomes difficult. That is the political risk. And we as an Indian have been exposed to this political risk. We have bad relation with Pakistan or China, two of our neighboring countries, and that can affect you in your businesses. So that is political risk. This type of risk is faced by an overseas investors. The adverse action by the government of the host country may lead to huge losses. That is very true. So when the Indian government has banned so many Chinese apps which were doing good business in India, it caused loss to them. They will also reciprocate, and that will cause loss to our business. In fact, many of the Chinese companies which have invested in India, they are rethinking. Like for example, Alibaba and some more. People have started banning or not using those Chinese mobile phones which are quite cheaper, reasonable for large masses of people. That is the political risk. What can be done? So political risk will involve when you do business which with other countries, or other countries also are involved in your business. Be aware about such risk. Confiscation or destruction of overseas properties. Confiscation means the government will take away your property without paying compensation or enough compensation. In fact, sometimes they destroy the properties of foreign companies, right? So some people will attack mainland China restaurant, nothing to do with China, but yes, Then rationing of remittances to home country. They will put a restriction on remittances of fund. You have money, you can't remit. There is a rationing, limitation. Then restriction on conversion of local currency of the host country into foreign currency. So conversion of your currency into their currency may not be allowed there. So your money gets blocked. Restriction on borrowing. Try to borrow from a company or a bank in Pakistan and see what government of India will do. They will be after your life. Invalidation of patents. Even though your patent is well registered, other country may not accept it. And the price control of the product. These are the political risk. Next risk is interest rate risk, on which we have already covered a chapter called interest rate risk management. So here I will just go through little fast because one full chapter we have done on this. This risk occurs due to change in the interest rate, resulting in change in assets and liabilities. So for example, you have invested in 8% bond. Please answer my question. Market rate of interest rises to 10%. What will happen to the value of bond? What will happen to value of bond? Question mark. The value of the bond will fall. So if the interest rate goes up, the value of the bond will go down. That is the risk. And this risk is more applicable to those entities whose main business is related to borrowing, lending, investment, like for example banking companies, because their asset side is also assets which are risk based asset or interest rate based asset, that is receivables, loans, and on the liability side also they have fixed deposit and borrowing. So asset side, liability side of the bank are having asset which are interest rate sensitive, or for example non-banking finance companies, even they are exposed to this risk, and even corporates are exposed to this risk which are heavy borrowing or lending. Because of the changing interest rate, sometimes these companies, banks, NBFCs can suffer a loss. More about that we have studied in interest rate risk management chapter. There are two types of interest. One is fixed, the other is floating. In case of fixed also there is a risk. If you have borrowed money at fixed rate, suppose it's a 10-year bond and you have borrowed at 9%, even if the market rate of interest falls, you still end up paying the same 9% rate of interest. If you have borrowed at a floating rate, so you thought let us borrow at a floating rate, LIBOR plus 4%, what can happen now? The LIBOR may start going up and you pay more and more cash outflow. So as a borrower we are exposed to the risk, as an investor also. So if we have invested at fixed rate and the rate goes up, the value of our bond will fall. Okay, so these are the risks with investment or borrowing in fixed rate and floating rate. You can't avoid this risk. If you take fixed rate, then also there is risk. If you take floating rate, then also you have that risk. Now we'll come to currency risk. Currency risk means the exchange rate between home currency and foreign currency can change, and it keeps changing, because in India the interest exchange rate is flexible. Exchange rate is not fixed by the government, it is fixed by the market. So this up and down will continue as far as exchange risk is concerned. This affects organization dealing in foreign exchange. This example we have discussed so many times, like for example, exporter, invoice value 1 lakh, payment will be received after 3 months, spot rate 75 rupees per dollar. He received the payment after 3 months. After 3 months, what happened? The rate is 70 rupees per dollar. So when he goes to the bank to convert into rupees, he will get 70 lakhs instead of 75 lakh. In the process, he lost 5 lakh rupees. If you are an importer or any party who has to make payment after some time, dollar 1 lakh, after 3 months, the spot rate when you had entered into the transaction was 75. After 3 months, the rate is 82 rupees per dollar. How much loss you will suffer? 7 lakh rupees. That is the exchange risk. This risk can be favorable or unfavorable. So when we are talking about risk, we are mostly looking at the adverse impact of that risk. Example, rupee depreciate vis-a-vis US dollar, receivable will stand to gain vis-a-vis the importer who has the liability to pay the bill in US dollar. So when rupee depreciates, exporter will enjoy, importer will cry.